Hello everyone, today I've got something slightly different for you. I wanted to talk about an upcoming IPO. It's a company called Cordiant Agricultural Income Trust. So something very different and something that I've got some interest in.
But before we get into it, the disclaimer. Everything discussed during the Portfolio Matters podcast is for informational purposes only and should not be considered as investment advice. Listeners should be aware that we will be discussing securities that we own or have a financial interest in. Please do your own research or consult a professional investment advisor before making any decisions regarding topics mentioned on the show. A full disclaimer can be found at the end.
So the pitch from the company is to provide medium-term financing to crop producers. So that means 4 to 7 year loans of about $5 to $30 million. And they're hoping to get interest rates of around 7 to 10% on these loans. So that the pitch is basically looking at South American agricultural producers who are not able to get financing from regular banks. But these are not small-scale farms. These are farms with over $50 million per year of output and experience of over 10 years in exporting. Now the pitch from Cordiant is that these companies, these farms are ill-served by banks. However, they've got a big need to modernise their technology and to introduce more sustainable means of production. So this is things like, for instance, drip feeding of water to crops rather than blanket spraying, or changing energy sources to provide more sustainable production. And this is all within the context of global food demand being on the rise as a direct result of population increase across the world, but also the developing world edging away from eating meat, more preferring a plant-based diet. So that's the pitch, reasonably chunky loans to big agricultural producers in South America. So the opportunity for an investor is, the pitch at least, is for a 10% total return, of which about 6.5% is expected to come from income from the divvy. That will be when they're up and running. I think in the first year they're expecting more like a 4% income return. Now, I've got a little bit of form in these direct lending trusts. Some of them have gone quite well, Starwood Real Estate Lending and GCP Asset-Backed Finance, but I should warn people that I did do a my worst trade on a similar asset-backed lending opportunity, SQN, that went horribly wrong. So, when you're thinking of equity returns, you might hope for sort of 6-8%, but there's going to be a fair amount of variability around that, and you secretly hope it's going to be 15-20%. But of course, in a lending opportunity, the interest rate that you're charging, that's your maximum. You're never going to get better than that. So it's all downside from the 10% maximum that they're looking for. So I think it might be much more reasonable to be hoping for perhaps 7%. So this is a rather different sort of opportunity. What are the risks, and what is the manager doing in terms of mitigation? Well, I think the first thing I was thinking of is definitely this needs to be pretty diversified. You can't just have one or two loans. They're hoping to raise $300 million. Let's see. If they don't get enough, then I think the offer should be pulled. It wouldn't have enough diversification. And we've definitely seen some investment trusts not raise enough and just flop. But I don't think you should regard a flop as a bad thing. It's more, well, look, there's no point going ahead. Turning to the more usual risks, well, how about if the borrower doesn't repay? Well, here I think this is one of the interesting aspects of the trust. What they're proposing to do is to make the borrower, enter into an offtake agreement with buyers. So the buyers might typically be a supermarket, such that the investment trust that has made the loan is receiving payments in dollars directly from the user of the crop. So it isn't a question of the farm selling the crop, getting the money and repaying the investment trust. It's a different route, cutting out the farm in terms of the return of capital coming directly from the ultimate buyer of the crop. And the trust also says that it's going to ensure that the contracted crop sales are 1.5 to 2 times the debt service that the farm has undertaken. Another particular risk, well, this is quite unusual, isn't it? This sort of lending, I haven't heard of this sort of thing before. So you have to wonder about the degree of expertise and who knows about this, unless you're a local bank on the ground. Now, Cordiant claim that they've got a $475 million already being run in private assets following the same strategy. So that's the mitigation, that's the claim that this is not being done from scratch. They have experience, they have people on the ground. Again, a more traditional risk, or default risk, well, the loans are supposed to be 1.5 times collateralized against using the farm property, and that the debt is supposed to be amortizing, again being paid off via the offtake agreements from the ultimate crop buyers. A more sort of technical immediate risk that investors face is cash drag. We've definitely seen some investment trusts launch, raise money and just sit there because they can't invest it. Cordiant say they've got 100 million of a seed portfolio ready to take on. So at least 1/3 of the fund should be invested and earning interest from the get-go. Now, turning to some practicalities, well, this is an offer that's open at the moment and it closes on the 7th of April, so a couple of weeks to go. Also worth being aware, the ongoing charges look like about a 1.4% per year drag, 0.95% of which is the management fee. Also, there are dollar and sterling share classes. I think the sterling one is just so that they can be the stock can easily be held in an ISA. And a more esoteric point, but any subscriber in the IPO are going to get what amounts to warrants on the investment trust to try to counter the dilution that inevitably happens when a trust is launched. It might launch at $1 per share, but the NAV is almost inevitably a bit less than that because of the costs of the issue. So there's going to be some warrants issued to try to offset that. So, in conclusion, well, I've got to say I'm tempted by the yield. I'm not like Keith. I can't sit out of the market and earn nothing when I see inflation of 6%, 7%, 8%. I want to be trying to keep up with that. And I must say I am tempted. I don't really believe 10% total return is likely, but 7% seems more possible to me. I also see it as very diversifying, very little like this in the market, not really linked to the economic cycle. This is a much more fundamental commodity-based offering. It is, however, unproven. It's an interesting strategy, but it's the pioneers who are the ones with the arrows in their back, and it's unproven, isn't it? So in conclusion, perhaps a nugget, perhaps a little exposure makes sense, and keep monitoring it into the future.
Full disclaimer. The material and information contained in this podcast is for information and entertainment purposes only and should not be relied upon for making a business, legal or any other decision. We may own or have a financial interest in any securities mentioned. Listeners should conduct their own research or consult a professional investment advisor before making any decisions regarding topics mentioned on the show. Whilst we endeavour to ensure that the information presented on the show is correct, we make no representations or warranties of any kind, express or implied, with respect to the podcast and website or to any information, products, services or related graphics discussed or presented in the podcast or website. Any reliance you place on such material is strictly at your own risk. You are solely responsible for the investment decisions you make. We will not be responsible for any errors or omissions in the podcast or website, including in articles or postings, for hyperlinks embedded in messages, or for any results obtained from the use of such information.
nor will we be liable for any loss or damage, including consequential damages, if any, caused by a reader's reliance on any information provided by the podcast or website. Please do not listen to the podcast if you do not accept self-responsibility for your actions.